Hello and welcome back to Stocksage Insights. I'm Faraz, and today we're going to unpack Nike's latest financial results. But before we dive in, I want to give you a heads up about my next video where I'll be discussing Barron's top 10 favorite stocks for 2024. There are some exciting insights coming up, so be sure to subscribe and hit that bell icon to get notified when that video is released. Now, let's get into Nike's second quarter performance and what it means for investors. Just yesterday, Nike released its results for its fiscal second quarter, and there's a lot to unpack here. We'll start with the top line, which offers some interesting insights into the company's current market standing, and then we'll delve into the bottom line to understand Nike's business strategy. Finally, we'll touch upon Nike's valuation to see where it stands in the market. Let's break down the numbers. Overall, Nike's revenues were slightly down, with a 1% decrease on a constant currency basis to $13.4 billion. Particularly in North America, Nike's biggest market, revenues fell by 3% on a constant currency basis to $5.6 billion. This decline was led by a 5% drop in footwear revenues, which is quite significant given that North American footwear is considered Nike's most crucial segment. This was contrary to expectations, as North America was predicted to be a strong performer. In the EMEA region, Nike's second largest market, the story wasn't much brighter. Here, revenues fell by 3% on a constant currency basis to $3.57 billion. The most notable downturn was a 10% decrease in apparel revenues. Moving on to China, a market where there was a lot of optimism, the results were somewhat underwhelming. Total revenues rose 8% on a constant currency basis to $1.86 billion, but this was short of Wall Street's expectation of $1.97 billion. Nike had previously set high expectations for growth in China, but the reality was a modest increase, particularly in footwear, with only a 3% growth. While apparel and equipment sales saw significant surges of 24% and 36% respectively, these categories represent a smaller portion of Nike's business in the region. Turning our focus to the Asia-Pacific and Latin America regions. These areas showed promising growth, with sales rising by 10% on a constant currency basis to $18 billion. It's a bright spot in an otherwise complex revenue picture for Nike. When we look at Nike's revenue trends over the past few years, the path isn't that of straightforward growth. Economic factors have definitely played their part, but it's also about the increasingly competitive athletic footwear market. With so many strong brands now vying for attention, and consumer preferences shifting in response to both economic and geopolitical factors, the landscape is more challenging than ever. A notable trend, especially in China, is the growing preference for local over Western brands, reshaping market dynamics. This uncertain environment is reflected in the cautious tone from Nike's CFO, Matthew Friend. He recently indicated a tempered outlook for the coming months, noting, "As we look ahead to a softer second-half revenue outlook, we remain focused on strong gross margin execution and disciplined cost management." The CFO's comment, highlighting an expectation for profitable yet potentially slower growth, seems to have scared the market, especially as we're now in the second half of the fiscal year. It's a clear sign that Nike doesn't foresee a rapid turnaround in the challenging demand environment, a sentiment we haven't frequently heard from the company's executives. Note that Nike's financial year runs from June till May, and it has so far reported results for the first and second quarters. Nike has guided for third quarter reported revenue to be slightly negative. And for the fourth quarter, the company believes that its reported revenues could rise at a low single digits rate. In short, Nike has seen modest revenue growth, and based on the guidance, we can assume that this problem will persist, at least in the short term. Despite the uneven path in revenue growth and a guarded forecast, it's not all grim. Nike's profitability tells a somewhat different story. The company recently reported a net profit of $1.6 billion, a rise from $1.3 billion the previous year. What's more, its profit margins expanded and outperformed expectations. Nike's gross margin saw an increase of 140 basis points from last year, reaching 44.6% of sales. This exceeded the consensus estimate of 43.9%. The margin improvement was primarily driven by strategic pricing actions and lower ocean freight rates. However, this was somewhat offset by unfavorable changes in foreign currency exchange rates and rising product input costs. This leads us to a crucial aspect of Nike's strategy. As growth becomes increasingly challenging, Nike is zeroing in on optimizing its operations. They're undertaking significant measures to reduce costs, streamline processes, and enhance efficiency. Nike's cost-saving initiatives include cutting down management layers, simplifying product assortments, boosting automation and technology use, and leveraging their scale for greater efficiency. In total, Nike anticipates approximately $2 billion in cost savings, though this will entail pre-tax restructuring charges between $400 to $450 million. Essentially, Nike is honing in on margin improvement. In a market where they can't control everything, focusing on what they can do, like costs and operational efficiency, is a smart move. This approach echoes what we're seeing with other companies, like Under Armour, who are also working on internal turnarounds amidst market challenges. Looking ahead, with this renewed focus, I think Nike's profit margins could stay robust, helping it maintain its status as a highly profitable apparel giant. Nike has always been known for its pricing power. It has historically enjoyed a healthy net profit margin of around 10%, in a sector where profit margins are less than half that. Nike's 5-year average net income margin is a robust 10.5%. Despite concerns over weakening demand and tepid top-line growth, Nike's emphasis on cost control positions them to sustain high profit margins. Now, let's shift to Nike's valuation. Traditionally, Nike's shares have commanded a premium compared to its peers, typically trading over 35 times forward earnings estimates and around 34 times trailing 12-month earnings. The current valuation follows this trend, with a forward P/E ratio of 33 and a trailing 12 months P/E ratio of 37. While this doesn't present Nike as a value play and the valuation might not seem immediately attractive, Wall Street maintains a consensus buy rating. The company's prospects for future earnings growth and margin expansion can have a positive impact on its shares. Our next video will delve into Barron's top 10 stock picks for 2024, and it's filled with potential opportunities you won't want to miss. Make sure to subscribe and hit the bell icon to get notified as soon as it's released. If you find my content valuable and want to support me, please back me up on Patreon. Remember, investing is about making informed decisions, and here, we strive to provide you with the insights you need. Before I wrap up, I must remind you that everything you've heard in this video is just my opinion, not financial advice. Until next time, keep your investment game strong.